perhaps I'll introduce myself before I introduce the panelists, and we'll dive into the topic. My name is Christina Frankopan, and I'm a fintech and blockchain consultant with Lazard's Financial Advisory. I've been involved with blockchain since 2015, mostly advising VCs on investment strategies, among other things. And I'm an industry associate of UCL CBT. So thank you, Jeff, for chairing today, to Paolo and the other organizers for convening this conference. Some excellent content, and thank you too for inviting me to moderate this panel. Our topic is the global pandemic and new opportunities for financial technologies. We're going to discuss how financial technologies, and in particular blockchain, are providing opportunities for commercial applications. So while things like CBDCs and stablecoins are relevant to the discussion, they've been well covered in the conference, and we'll be touching on them only to the extent they pertain to private sector opportunities. We're also going to discuss how the pandemic has or has not accelerated some of these technology trends, and perhaps touch on some of the consequent policy directions. So we have a very prestigious panel. I'm sure we're going to have a very lively discussion. I'll let Paolo, Carey, and Mark introduce themselves, perhaps outline their roles within their respective organizations and some of their research interests, and maybe help us set the scene for the panel by setting out your thoughts on what indeed is the role of financial technology in the context of the pandemic. Can I pass it first to Carey?
Yeah, sure. Always happy to go first. Hi, everyone. I'm Carey Bimaya, and I am the CTIO of Capgemini Invent. Capgemini Invent is a division within the larger group of Capgemini, which pretty much focuses on the new and the next. Our job is to kind of figure out what's actually happening on the market, where's the new emerging technologies, how they're going to be applied, and build actual solutions around that, either from a tech perspective or also from a creative perspective. Prior to taking on this role, I had some experience in strategy consulting. Before that, I was a director of research in a startup where we built an NLP-based search algorithm. And before that, I did some work in academia, which also included the publication of a book called The Blockchain Alternative. This was well before CBDCs actually became a hashtag. So when I published this book, it was essentially my exploration to figuring out if blockchain technology could be used to resolve issues of excessive sovereign debt. So yeah, I think I'll stop with that, and I'll pass it on to Paolo.
Hello, everybody. So I'm Paolo Seroni. I'm the global research leader in banking and financial markets for IBM, the Institute for Business Value, which is our thought leadership center that wants to discuss business model transformation. So the focus is really on the business model and how technology can power it up. I had the opportunity in the last years to visit almost every corner of this round planet. And I think we can divide the world into three macro areas without forgetting anybody. We have the United States, where digital technology was born, largely speaking. We know that, for example, the Chinese are becoming very competitive. We have Europe, where most of us are sitting today, which is basically where regulation is born. It is very important, not just for Europeans to create a common level playing field, but also to protect the final consumer, the investor, in essence. And what I want to highlight is that in reality, the winner of the fintech revolution these days is China primarily, and particularly India is very aggressive these days, because there the business models are born. So my role in IBM is to understand the business models, knowing that not all of them can be exported, understand which technology can power them up, knowing that not all of the technologies are at the same level of maturity, and keeping everything inside the regulatory framework to make sure that it does good for society and doesn't fire back.
Great, and taking over from Paolo, my name is Mark Esposito. I'm an academic. I've been working at Harvard since 2011, and I was attached to Harvard Business School, Michael Porter. So heavy work on the competitiveness was the initial part of my career. Then I migrated over to more fourth industrial revolution area work, and I started a series of appointment in national government as advisor for this intersection between technology policy and business. Co-founded an artificial intelligence company called Nexus Frontier Tech, where I'm currently the chief learning officer. So there is there's an entrepreneurial hat that I'm wearing. And in 2019, I was appointed as professor at Arizona State University, and I'm co-director of the Center for the Fourth Industrial Revolution. So we are using the power of the largest public institution in the United States, Arizona State University, to advance the agenda of the Fourth Industrial Revolution. And this has pretty much created a portfolio of interests that I have. I'm currently in Dubai because I've been appointed by the Prime Minister's office within the digital infrastructure and digital economy. So I've been working since June in advancing a quite critical agenda that this government is pushing forward. It's just the very beginning, I think, of an entire transformation of the government's orientation on where value will be generated in the future. My relationship with fintech and blockchain is primarily research-based, but I am an associate with UCL in the Blockchain Center, and it is thanks to them that I'm here joining Paolo and Kerry. Christina.
Great, thank you. Mark, you don't look like you're in Dubai.
No. My background is not as exciting as Paolo and Kerry, so it's the first one.
Well, you can ski indoors in Dubai, so maybe it's not the case.
Yes, no, actually, I'd like to start with that, about this global topic. It's interesting what you referred to, Paolo. This idea regulation is born in Europe and business models are born in China. And is there some sense that in the context of the pandemic specifically, that there's been an acceleration of the sort of perennial digitalization of financial services, and that this has a particularly global edge? How do you see that in the sort of global context, in the context of COVID specifically? Has there been an acceleration?
Well, there has been an acceleration, but if I can say that acceleration is about the awareness, then relationships are important. So everything in technology that enables people to stay connected and to reach out has become of utmost importance. And that touches every point of the digital transformation and the digital adaptation. Now, I think that the pandemic is giving us a very, let's say, interesting, even though it's an unwanted opportunity, to reflect on the way that we are deploying technology for the good of society and humanity in general. You may remember I opened this conference last year with a presentation in the press room of the European Central Bank of my latest book, The Financial Market Transparency Theory. And at that time, we discussed the microbiological foundations of finance, which are basically the concept of time and most of all, the one of fundamental uncertainty. And that was very prescient. We didn't know about the pandemic coming. So what the pandemic has created is that fundamental uncertainty has been skyrocketing up to the roof. And when that happens, things are triggered and set in motion. And we need to understand what these things are and understand how to remediate that also with technology. So now Asia, again, proved very interesting actions to be taken as good actions in terms of how to fight the pandemic. And they've been inspiring for many countries. I remember an interview on the BBC, if I'm not mistaken, or the CNBC, of the foreign minister of South Korea, that is one of the countries that did not go through a full lockdown like the European countries, and adopted technology in a way of in attempting, if you like, to mitigate the effect of the pandemic. So she said that the three pillars that were guiding their actions as policymakers were transparency, openness, and advice. So why does this matter? It matters because transparency means being capable of telling to the public in proper ways what we know and what we don't know about the cure, about the disease, about the vaccine, in a way that we invite people to take responsible actions based on fact which are grounded to reality. Now, transparency is the key governance principle of any platform. And if we talk about DeFi, we talk about blockchain, we need to ask ourselves how much transparency this is infusing inside the financial system, because that's the way we can mend the trust in between the institutions, the intermediaries, and the final consumers. The second principle was openness that she discussed. That means in order to accelerate finding a solution, data needs to be shared among doctors, hospitals, research centers, governments, and so on and so forth. Now, we've been all talking about open banking, open data, open finance. It is so important that everybody understands that since the financial markets and the banking sector is facing unprecedented uncertainty because of the new normal that the COVID is just accelerating, that is made on social tensions, reduced economic capabilities in terms of interest rate margins, because interest rates are 0 to negative, high cost of capital, very tough competition on the fees in the embedded investment products. Only by blurring the lines that divide the business unit of banks, or that closes the data inside banks without letting that flow through systems that can generate a new business value, that will not be basically a solution that can be achieved. So it is important to understand the element of openness as a key principle to face uncertainty. And the third one, of course, is advice. And then is one of the one I care the most, because I feel that many people working in technology look at data as a mechanism to build data-driven solutions that basically are nothing but an optimization of the marketing routine. But now, after 10 years of fintech innovation, whether it is DeFi or not, I think that we've been learning that consumers don't necessarily on board on digital the way that many people thought them because of the information asymmetries. Therefore, it is important to care of the motivational aspects. So I've been working a lot around the concept of motivational platforms. The last work was done with the Shanghai Pudong Development Bank, and I presented it at the Ant Financial Conference in Shanghai a few weeks back with the title Panoramic Banking. So the idea here is that you need to take care of building a data-driven client, so to empower individuals transparently with open data to understand the financial relationship so that they are motivated to act digitally. Otherwise, it can even happen that in places where finance is already accessible, like the Western world, instead of building more inclusion, we end up building more financial exclusion, and that is to be avoided. So therefore, the key lessons learned from the pandemic are transparency, openness, and ongoing advice.
Very interesting. I mean, maybe we can pass that on to Carey, because I think when you talk about data-driven approaches and the humanizing of financial services and technology provides an opportunity for that, or indeed a need perhaps during this COVID pandemic. Carey, I don't know whether you'd like to respond to that and maybe touch on the idea of how different types of technologies may interact, say DLT and AI, towards that sort of data-driven types of commercial models.
Yeah, I can kind of build off on what Paolo just said in terms of actually what data means. Let's take a step back from the whole technology focus for a second and actually figure out what's going on. There was some really interesting Q4 results that were published this year. And one of the ones that I was super impressed by was Fiverr, the online marketplace, which saw a 678% growth in the course of COVID. The reason for that is pretty obvious. A lot of people were laid off. They were looking for different kinds of jobs. So they went to these online marketplaces where you could sell your services, whatever it is, if you need to do data cleaning or building something creative. And what really is happening over here is the kind of interaction and the digital footprint of a person is getting increasingly clear. Why is this important? Is because when you have this data, what you're essentially able to do is create multiple digital avatars, and which all have a financial kind of interaction happening of a single person. And where these platforms exist, where these people exist, the kind of data that they do, the kind of interactions they do, that's essentially what you're trying to get. Because if you're a financial services provider, you can't really go and get some blanket kind of solution. It's not just the need for doing some kind of customization mantra in order to show that you actually care about your customers. A single person will have different kinds of needs as they're evolving. And what these platforms are actually capable of doing today is providing that information for you. And hence you can now start building something around that. One of the people who seem to be taking a first step towards that is the recent Google Pay update, which has happened, and they've done the partnership with Citibank. Why are they doing that? Because they realize that people interact with different groups of peoples in different ways. If I'm sharing a bill with a friend, that's a different type of interaction. If I'm doing it with a business, it's a different kind of interaction. And what they're doing is they've given one simple platform with the ease of sending money is as simple as, just sending a text. Now, if you have access to that kind of data, you're starting to capture all these multiple digital financial avatars of these people. And now it becomes a lot more easier for you to start figuring out what are the kinds of services that they require. Who do you need to target if you're trying to come up with a mortgage kind of a product or an insurance kind of a deal? And while it's still very, very early days today with Google Pay, I come back to what Paolo mentioned in the beginning as to where is it being deployed? The product was made in the US and they're launching it over there. But the same day that they launched it over there, they didn't really launch it in Europe. There's a couple of countries where they've done it, but they're not huge countries. The place where they launched it the same day is in India, because they know the inclusion happens faster, the customer adoption is a lot faster over there, the market is a lot bigger, and there's a lack of financial services. So this is when the AI or the DLT kind of tech becomes interesting, because now you've got a very sizable base on which you can act upon, compared to, let's say, places in Europe, which is still a bit restrictive for good reasons, though. But this is kind of like the way that we're seeing it. And I can build up on any of these points if you want.
Yeah, very interesting. Perhaps we can bring Mark in to respond to this topic as well. I'm sure you have some thoughts on it.
Right. Well, I think there is I'll try to take the tangent related to, first of all, how an organization that doesn't really have an architecture on data, right, but try to advocate for artificial intelligence these days is missing part of the story. And I think question on data training and how we're going to build meaningful data and the relationship we're having with data and third-party data is becoming more and more relevant in the years to come. And I think the conversation will be more about how do we make sure that this conversation is becoming available for more people, considering that one of the benefits of the pandemic is the reduction of cost of technology. And now more people can actually get closer to the opportunities that are coming with the digital transformation. There are estimates that, going back, Christina, to one of the first questions that you were asking, right? We have an estimate that McKinsey has published that about 10 trillion US dollars of potential new economic value have been, to some extent, incubated by the acceleration of COVID, a range of about 7 years of acceleration within 8-9 months. And one of the quickest adoption of digital transformation that doesn't only mean that companies are transforming, but it means that investors are supporting, users are expecting, and value chain are creating a much more digital output altogether. I think this is creating an entirely different setup, which is coming from a seismic shift at first. But going back to one of the areas that I always look after, which, as you know, is more of the government relationship, how will government be able to really deal with all of this, considering that the pace of transformation is happening at a much faster pace than how governments are capable of dealing with this? And I'll bring an example. I was interviewing the head of EU relationship with Facebook yesterday in my class that I run still at Harvard. And she was saying, Facebook wants to be regulated. We want to have regulation and clear indication on the tax profile, but we find that the governments are unable yet to meet this conversation in a way that is meaningful. So while I'm taking conversation like this with a pinch of salt, I think that we're dealing with circumstances in which technology companies are dealing with global challenges, given the complexity in which they operate in an economy scale, which is implicit by their business model. But government are still operating at the relatively government level, which is very nationally bounded. And I think this tension between the national level and the global challenges will redefine relations in the multilateral organization. Reason why, on a more macro political level, the EU-US relationship in the Biden administration will be critical, especially to address some of the challenges that came with the transformation of the value chains, but also to make sure that this hypothetical amount of new value in the economy will be triggered to create a form of distribution that doesn't only go to the platform, the technology company, but is going to be permeated also in the real economy. So I think there's a lot of macro and micro playing at the same level. The interlinkages is much more fluid than before, but what is at stake is also much more. Because if we get this wrong, then we're going to institutionalize the K-shape as the oldest shape we really have.
Yeah, interesting. Maybe I could just stay with you for a moment, Mark. I mean, to what extent are those dynamics a function of the COVID, or specifically, because it sounds like some of those are perennial geopolitical trends, and indeed we've seen them more broadly in fintech. They don't necessarily relate to peer-to-peer technology specifically. Or how much of this is a question of policy, and how much of it is a question of the opportunities that the technology specifically provides?
You know, I find, Christina, that with the exception of the emotional engagement that COVID has created, nothing is new.
Yeah.
We simply accelerated the existing dynamics, right? Even vaccine, I mean, thinking that this organization started entirely from scratch would be very naive. It just, they didn't have the funding that came with mainly an emergency plan like the vaccine has actually instaurated. So I think the question is more about how we see the pandemic as this echo chamber that has accelerated us at a faster pace, and how do we build an institutional response mechanism to deal with that? Because it was already 2015, 16, 17, when the fragmentation of the institutional framework was becoming very clear, where the traditional socioeconomic players were becoming weaker, where we already consolidated in the hands of an entirely different conglomerates. They were no longer coming from the industrial model, but they were coming from the digital structure. So I think COVID has simply revealed by unveiling, right, what was already happening. And now it's much more in front of our eyes, and is pushing for governance or regulation on one side. It's pushing for reforming of the standards, because without the standards, I mean, standards are so important to allowing millions of small, medium enterprises to be part of this. I think this is where I see the challenges happening, but they are mainly institutional challenges. They're not challenges that are coming necessarily with technology. I think technology does what technology is designed to do. Is the immaturity of I think the institutional system that I find really require some form of upgrading. So that's where
this point which Mark's making in terms of code accelerating the future is it's really that, and it's really putting a lot more importance on pragmatism. I think there was a quote or a tweet that came out in April or May by Satya Nadella, in which he said that in the past 2 months they've seen more digital transformation happening in companies compared to the past 2 years. And as this happens, people have been talking about digital transformation, AI for the past 5 years, nonstop. You go to any conference regarding tech, it's over there. But what's happening today is we're giving more importance to, if you're building AI, for example, AI economics and AI as a service models are not the same as SaaS models. Why? Because when you create an AI, first of all, developing that has got a lot going on. If you stop focusing just on the model, there's everything else that comes into play, which is very time consuming, like just the data preparation, et cetera, et cetera. And as that starts happening, then you realize that even if your AI model works, there's the constant problem of data drift. If you talk to anyone who works in AI, they'll tell you that the 90% automation is easy to do. It's the last 10% that is constantly elusive, because you have to get new data, retrain the models, et cetera, et cetera. And there's a huge cost that comes into that. So the same kind of business models don't work. But at the same time, it also creates a fragmentation of the value chain of how these technology works. So in the last talk, we were listening to Thomas from MIT, and Thomas actually mentioned the point of function as a service. That's something which I really liked, because we're seeing that today with AI. A lot of the teams that we work with, or even startups that we work with, we see that they're getting increasingly specialized. So you now have services just like, for example, the data collection, synthetic data set creation, to train these models and kind of retrain them again and again. It's now becoming a commodity. It's something that you can buy on a subscription basis. And that puts your cost down, which allows you to really scale these AI models in a much better way. And that's important because moving forward, again, large institutions, whether it's government or it's these very old companies with legacy systems, they're not able to give the kind of value which consumers require today, especially when they're hit with uncertain shocks like COVID. So being able to have some kind of pragmatic system in which tempo trumps preparedness is becoming increasingly important as we move forward.
Yeah, and Paolo, I'm sure you'd like to respond to that too. And I'm particularly interested, perhaps, if you could bring out the idea that the technology provides, on the one hand, new kinds of opportunities for new markets, say data-driven markets, but also new kinds of business models that you had touched on earlier.
Yeah, so I don't know if I can share my screen. Can I try to do that?
Yes,
I just came to think about that, because this is part of the panoramic banking white paper that I mentioned, SPDB published in Shanghai a few weeks back. And it goes back, I guess, to a concept that I've been reading on a research paper of the European Central Bank that was published a few months ago in July, if I'm not mistaken. The title is Financial Intermediation and Technology, What's New, What's Old. So the ECB says that the strength of financial institutions is based upon two elements, information and communication. And they're very different. And they're observing, as I'm observing, that information is becoming less and less relevant, while communication is becoming more and more relevant. Now, I can plot this on the diagram, and where I can start discussing business models. You've got the communication quotient. This is a reedition of the product invention grid of Sophie in this very interesting book. So you have the intensity of communication, the usage of artificial intelligence, for example, that goes into the intelligent relationship to the far right. And on the y-axis, you have the information quotient. That means the utilization of data that typically is part of core banking that is used, largely speaking, for the adverse selection, finding the best clients to provide him with credit for the highest rate. Now, you know that that type of information is becoming a reduced opportunity for banks in terms of generating value for the shareholders because interest rates are very low, if not negative. But that is where you see the transformation towards platforms and ecosystems because data starts flowing in a very different way. So the information takes a completely different meaningfulness compared to the past. And that brings you a shift from the output economy to the outcome economy. That is what banks really are striving to do. And whenever we talk about technology, we need to ask ourselves, what is this technology for in terms of helping the intermediaries to make this transformation from output to outcome? The difference between the two is that output means BMW has to sell 1 million cars next year. Outcome is BMW wants to mobilize 1 million commuters every morning to go to work. In terms of banking, output means I want to sell 1 billion of this monetary fund. In terms of outcome, it means I want to help my clients to achieve their personal, their business, to their financial goals. So if you move up and right, you get into the new value space. You see traditional and digital banking, as we've been seeing them before the pandemic, were very much linear businesses in finance. So you have a manufacturer, you start to package this into a different mechanism and you give it to consumers. Whether you do that with technology or without technology, doesn't matter. It always works the same way. And this reason why it did not, and this is the reason why it didn't really flow and it did not succeed, largely speaking, because it was not thinking outcome, that means non-linear. So now, in order to make this journey, you need to get into two types of business models. We see in Asia, in particular, the appearance of contextual banking. We can mention SBI Yono in India, which is very interesting. We can mention some cases of DBS. We can mention even Ping An in China for insurance, or Bank of Baroda for agribusiness in India, once more. And in the Western world, we see the emergence of bundle banking. There will be an interesting session at the Singapore FinTech Festival next week, which is really talked about, titled Bundled Financial Services. Because for 10 years, we thought that unbundling was the strength of FinTech, but that's a weakness. Because the powerfulness of platform is really to aggregate a variety of different elements of an individual lifestyle or a journey, and to provide a value on top of the whole lot is an holistic perspective. So here we see banks like UBS, for example, Morgan Stanley, that are transforming towards planning exercises. So in the Western world, we have the planning activity, which is becoming central in the business model, so the communication. And in Asia, we see information, that means platforms like marketplaces. And the biggest value will be when the two will start converging into something that enables you to motivate the client from the non-banking using a platform where the client sees itself in terms of what he's looking for, and the capability of bundling the financial services in a way that they become meaningful as a conversation, not as a marketing opportunity, but as a planning exercise for people to move forward in their life. And we see this appearing, as I said, here and there. We are at the very early stage of that. So anyone that wants to develop technology needs to ask himself, am I servicing a contextual banking type of business model or a bundle banking type of business model? Or in essence, the ambition of capturing the two at the end of this journey.
So I have an actual use case about this.
Yes.
I mean, Paulo's frameworks are always much better than mine. But one of the things that we're working with right now is the concept of the super app, right? So when I was in Vietnam in January, we actually saw, I was there with my mom, we just gone on a holiday, and I saw a lot of people, I was peering over and being inquisitive about the apps that they used. And they would use a single app to do multiple things. You want to call a cab, you want to order food, you want to do all these different things. You want to make a payment to your friend, you do it all on the same app. And this has already been going on for a past couple of years now in China. Increasingly, it's kind of starting to show its head emerge in Europe and even in the US. We're seeing a couple of apps actually try to copy paste that same model. But it comes back to what I mentioned in the very beginning, in which you have the ability now to get this much more holistic picture of the person, of the persona, and how these multiple personas behave on different kinds of contexts, right? The way that you spend and earn is very different on one platform compared to another. And it's really this kind of, I mean, the leverage of the bundle. The super app is just the entry point. Behind that, there is a whole slew of services that can be created. And if you are a banking company today, you need to think about the metrics in the same way a tech company does. What is a tech company's metric? If you're a YouTube or a Google, the metric that's most important for them is time on site. It's the reason they have 50 engineers behind every smartphone screen and a supercomputer behind them, in order to ensure that there is stickiness, there is a certain kind of addictiveness. Let's not talk about the ethics part of it right now, but there is a certain kind of addictiveness that allows you to be on that, because that's what they're ensuring. And I think this is something which is important for banks to understand. It's no longer just diversification of the portfolio in the traditional sense. You're entering a world in which you have to fundamentally think about how do you use your existing value chain components, those assets which you have, in order to target markets which are either non-traditional, non-core, or completely unconnected from your core business model.
Well, Kerry, I think that Mark knows well that the fourth industrial revolution is about platform and not data per se, but it's the way you use that in platform. So it is about the outcome economy. So if I have a criticism to the fintech movement and ecosystem so far is that they really did not think platforms, largely speaking. They always thought simple-mindedness, like individual solutions, is the idea of breaking banks. I'm a co-host of the wonderful Breaking Banks Europe. I always say you can't break a bank because a bank is already broken into different pieces and business units. So I saw for 10 years the startup aggregating themselves into pay tech, wealth tech, credit tech, insure tech, maybe blockchain tech. That is meaningful, that is meaningless. And the reason is because it's about client tech. So that's where you see the surgence of these super apps. Now, the way they do it is on very symmetrical products nowadays, which is non-banking, which is also important because it generates the motivation for people to be on digital. For finance, it's more complicated because apart from credit, when you have free money, it is very asymmetrical. Think about all the investment products, all the insurance products, and so on and so forth. Now, only capturing these two elements and understanding how you can think outcome to build platforms that bundle again a variety of fintech services in open finance, you will be able to succeed against the big tech players. Otherwise, really, it means becoming laggards or disappearing.
Yeah, and there's a lot of our clients, especially in the insurance space, that's kind of like their main area right now. We've been working with a bunch of the largest insurers in Europe and maybe even the world in trying to figure out, like, insurance products which are related to wellness and stuff like that. And this isn't something that's just because it's like something you find cool or as a trend. There is actual client demand for these kind of things. These things are mainstream today. So it really shifts the space in terms of how you reflect upon your own identity as a financial service provider. And the good part is there's so much inspiration from other areas, but getting that mindset shift is probably the hardest thing and not the technology.
Yeah, Mark, can I bring you on? I'd like to stay a little bit on this point, and perhaps you respond to what the others have said, but on the point of, are we seeing a structural shift in the way that financial intermediation happens through this unbundling, rebundling, embedded financial services, and so on, whether through super apps or otherwise?
Right. So actually, what I wanted to expand from what Kerry and Paolo just exchanged is, the bundling is important because it's shifting away from the attention on the inherent characteristic of a product or service. Therefore, you can come up with a whole economic model to define what is the value of something. And it's bringing that to a much more, as Paolo would say, contextual level, in which we're understanding that the transformation first doesn't happen in binary system, but it happens with degree of causality that has to be laid or delayed over time. And I think specifically to, I would say, the fintech kingdom, right? If you want to, for example, narrow down the conversation a little bit more, Christina, I would say what we've been noticing because of this mechanism of creating value outside of just the specific exchange of a given product service is, on one side, the investment are getting much more targeted. I think there was a time where many investors would try to do anything that would look and smell and kind of feel a little bit like fintech. And I think today there is a lot more of consistency in understanding that what you're investing in is not the specific, but is merely the ecosystem or the ecosystemic reaction of any given investment. And we've been noticing, so like in the landscape of 2020 in fintech, a bit more of investors, they're increasingly looking for companies that have demonstrated the ability to create value and revenue. And this is already quite something from the big buzz they used to have some times back. And I think also, if before it was more about being part of the buzz, today there's a clear understanding that if you're not having a path to monetization, that doesn't really go very far. Now, following on that, I think as investment are going to go more into a targeted model, technology itself is not the sole focus anymore. You know, it used to be that you're only investing in technology, but now I think we start noticing that existing infrastructure equally matters. I think there is an idea that technology is integrated within a larger collective design. And I guess that has equally changed the nature of how the investor thinks. This also means that there is a clear understanding as well that whatever used to work in the past very likely will not work in the future. And this is great because it's decreasing that dependency on this determinism of the past, which I think in finance was extremely addictive and quite ill-conceived, because this is the nature of historical data, is determined to creating a relationship with the future, because it reassures the investor since the past has tons of data, the future has none. So why don't we try to figure out a way to calibrate them into a model that will create an optimization of the past? This is no longer something that anyone believes. And I think COVID has probably created the clearer demarcation line on that. Then I think the big, great houses are back in the ring. You know, we used to think about fintech displacing and completing killing banks. And now we're noticing that actually what this has created is a space for banks to become more collaborative, acquiring capacity from the technology firms, but integrating them into what a bank really does, which is an institutional, almost fiduciary role that I think is still critical to have. I think we are clear that the buzz is over, that not every bank has become a platform, but they were really much more, utilizing technology to improve the relationship with the client, right? And the product offering, rather than simply thinking every single bank will become a platform, a Facebook, a Google, and all of that. And I think regulation is redefining the market opportunity. So I think government now are much more in the game in trying to create a relationship that tries to create also regulatory constraints. And I think finally in the trends that I'm trying to share with you, if we used to have this enormous, I would say, boost towards going public, today, many fintech CEOs, they prefer to keep their business quite private. They try to avoid having public scrutiny, and they try to see if there's an existing path to going public to find a way to fund their operation. And I think this is particularly true also for unicorns, which is, I think, is really creating a difference in the nature. So I would say the trends I share are related to the conversation that were coming from Paolo and Gary, but they're a little bit more narrowed down to what we observe in the fintech kingdom.
Yeah, it's also kind of diversifying the way that people actually think about liquidity and cash and how they can actually generate value. You know, history doesn't repeat itself, but it rhymes. And one of the new tones you're hearing in this new rhythm is the actual serious exploration of something which was totally non-traditional before. So for example, we're working on things today in which we're exploring how do you actually securitize, let's say, a publishing company based on video game assets. Right, and then this is like a serious conversation. When you see the amount of money that's there in the video game industry, for example, that's 150 billion a year and growing every year. So obviously people are inside over there. They're doing something. It creates value for them. If you don't understand it, that's a different story. But how do you actually do something around that? And companies like Back today, they're creating assets on that. Same goes with assets like art. In the past 18 months, we've seen so many new companies that have popped up, which are really exploring art investment in a very fractional kind of a way, in which it becomes very affordable for you to invest, let's say, in Andy Warhol, by making a micro investment over there and kind of riding the trend. So these peer-to-peer kind of systems today are being leveraged by the incumbents in different ways because they have the seriousness, because they have the necessary experience in it, and they also have a better foothold with the regulations so that they can actually capture new kinds of value, which previously was not something that was taken seriously. But as we mentioned, COVID has accelerated the future. So we're seeing these new kinds of emergences pop up over there.
So, Kerry, if I can say, I guess it's about the definition of value, because it would be a bit critical here.
Mm-hmm.
At the beginning of my career, for 15 years, I've been head of quantitative risk management for investment banks. At the time where we all talked about financial innovation, using quantitative finance to create new products, from the simplest, like Asian options, to the most complex, like collateralized debt obligations. That honestly was a way of building capacity to create fees in front of the final consumer.
Yeah.
So I'm not sure whether value was really generated in the very end, just because certain type of asset classes or bets were made available to the final customers. Now, if the global financial crisis is explaining something, is that starting from 2008, products are somehow moved to the periphery of the financial markets, for the simple fact that their embedded commissions are getting much reduced and squeezed. So that means that value needs to start coming from somewhere else, which is not the product itself, but is the human being, the client. And that what brings a completely different perspective in terms of utilization of technology and data. If I go back to the European Central Bank paper, the difference between information and communication is that communication is what targets the centrality of the client, hopefully not through a marketing mechanism, but through an advisory mechanism. That means the human centricity. And therefore, that is where the value is generated. Of course, it is interesting to access different type of asset classes at a time where everything commoditizes, passive investing is on the rise, so maybe I look for illiquid assets. But there again, I have a definition of value which is a little bit ambiguous because it is not that transparent as I may want to expect. So just try to bring access to less transparent investment vehicles. Of course, I can do that, but I think we need to move beyond that a little bit. And that's what I always advise the people that talk about DeFi too. Don't just look at the underlying technology that powers up the sharing of value in terms of the access to asset classes or bets or contracts. Think about how that can play in the life of an individual in terms of changing the way they work, the way they live, the way they invest, they save, they insure, they borrow, and therefore they ultimately behave. And if you do that, going back to Mark, that is very powerful, because you start creating a mechanism which is very micro. That powers up to become macro, because it becomes a completely different way of looking at the financial problem, not because it's more accessible, but because it becomes more meaningful.
For sure. And I think that's a key point, because if someone were to come up to me within my company or my team and propose the construction of an innovative financial product, which is another CDO or a CDO squared or a CDO cubed, I wouldn't touch it with a barge pole. I'm saying, like, no, you learn from your mistakes. We're not trying to.
I mean, I think that, Mark, maybe we bring you in on this too. I'm very interested in this idea of, the new opportunities that are arising and or accelerating, but how, the quest for value, if we're looking at the interaction between public and private sector participants in these systems and how they interplay, to the extent private sector or commercial opportunities seek out value, how does this interact specifically for financial services with the resilience of the overall system? I think that's something that's particularly interesting in the context of this acceleration.
So I guess the question, and trying to again blend the conversation we're hearing from industry experts like Power and Kerry, right, is this transformative level of technology impacting multiple dimensions that really creates a value which is even compound and an aggregate, but difficult to measure on a straight line. I always make an analogy. When you're looking at the value of a trade agreement between countries, you're not really looking at a straight line between country A and country B, but you're looking at the economic complexity the trade between two countries will generate within the shared production. And the more economic complexity you have, the more investors are reassured that the value of their money will eventually multiply by the degree of complexity. This was applied in trade. You can find it a lot in the work of Hausman and Hildego on the economic complexity atlas, where they were able to really measure this relationship between trade. I'm thinking we're looking at the very similar case right now. This large transformation that is happening is increasing the economic complexity of the transaction. Value chain, global supply chain, decentralized supply chain, nearshoring, you call it as you want. how do we mobilize the government to help and facilitate the access of value? Because that's what governments do, right? They facilitate value with equal balance than economic value, but differently measured, so that we can tap on the creation of jobs, opportunities, and investment that currently do not really exist. This is why I tend to always suffer the word recovery, because it implies some degree of reinstatement of the past. While I think we should really try to understand what they call the new normals. And Kerry was part of a report from Capgemini that we're talking about the new normals, right? One of the first that I saw in the industry, where we're talking about this asymmetry that Paulo was referring about, right? Is how do we make sure that the government is advancing the right leverage to facilitate value in an environment that became much more complex, which is translated in simple terms. How do we allow government to create a policy that will be equally agile and capable of move and adjust by approximating the nature of government's policy in the same way in which an entrepreneur would approximate it, right? I think this is a challenge that I see an opportunity for a country like the UAE, other countries that are designed to be agile. But imagine applying this in other countries where the institutional heritage hold us back so much. These are some of the challenges that I see opportunities.
Well, I would say that, Mark, the way to unlock value in complex systems is to simplify them. And how do you do that? You apply transparency. That goes hands in hands with your story about bilateral trade, because what it wants to create is a common level playing field, which is transparent for everybody to play with. And that's why I'm always very cautious when I hear ideas that build more complexity around the process of investing or sharing money and so on and so forth, because ultimately that fires back one way or the other. So transparency and simplicity.
And that's where the human in the loop comes in, because the difference between transparency and clarity is expertise.
Yes, and Kerry, you said the human, not the client. And we should discuss here, because sometimes we think of a client not as a human, but as a client. So a target of opacity of marketing and so on and so forth. Transparency is the marketing.
Yeah, it's like when you go to a big company and you ask the person who works in the back office, what's your view of the client? And they give you the most abstract answer ever. And if the further up you go, closer to the client, like people who are actually working in stores, they have a much more different view. And the biggest problem in change management is just aligning everyone on the same view.
Yeah.
Right. But to reconcile, right, I do agree, Paulo, that when we're talking about complexity, we're not necessarily increasing the lack of transparency as a proportionality of complexity. I think the complexity is the benefit we see this by the integration, but I agree with you that some degree of common language that simplifies, right, the rules of engagement is absolutely important. And I think maybe we should call it like this, we should call it rules of engagement. And this is, I think, where technology can give us enormous ability to simplify transactions that historically were preserved to be complex, because in complexity, you can also create much more arbitrage, right? So, but I think we agree on that.
Yeah, I might just interrupt because we're running low on time, and see if we can squeeze in a few questions. So could something, I heard there's one from Joubert Lopez, could something like cross-border global regulation compliance automation be viable or possible? How would this help accelerate adoption of DLT and other new techs? Would anyone like to take that one?
This kind of sounds a lot like what Thomas was talking about interoperability between blockchains, for example. And interoperability between blockchains has been going on for quite some time, but it's not really taken off. And I think that's something that's really important. If companies, let's talk about it from a country basis. If you really want to be able to take all the advantages of a blockchain and you're trying to do some kind of digital euro or sovereign level blockchain, the only way that works, and you also allow people to actually innovate and build on top of this, is if you have these kind of protocols which are able to communicate with each other. So I'm really curious to learn more. I only saw the last 5-10 minutes of Thomas's presentation, but for sure I'm going to be reading that paper.
Yeah, great, thank you. And then we have one more question from David Birch, without referencing specific companies, but many blockchain ideas that are pitched that he sees are pretty stupid. But transparency at the heart of the propositions makes sense. Maybe this one for Paolo. What does one think about various corporate corruption scandals and so on in this context?
Well, scams are not something of the past, are something of the present, and fortunately will be something of the future. We need to be very careful about that. The problem is human greediness and also the way we look at companies without asking ourselves what they're effectively doing, but hoping and pretending that they will be the next unicorn, and that's it. Again, when I discuss transparency, I position it at the heart of everything because of its powerfulness to let us think that the future is open. And therefore, we know that we know something, but there's a lot that we don't know. Whatever we do, that's an important starting point. And it's an important starting point in finance because finance is based upon a narrative that invites individuals to expose themselves on financial markets or for their financial life with credit without necessarily helping them to understand the implications that that has into their future. And so transparency means transparency on cost, transparency on incentives, which is on the side of the institutions, and transparency on the consequences, which is on the side of the clients when they make cunning financial decisions. If this is respected, the business model is ethical, sustainable, and is robust. If this is not respected, well, you can be lucky or you can become a predator, and good for you, but it will not be good for society.
Very good. Well, I think we have to round it up. I must say I come away from this very optimistic that notwithstanding the stresses of COVID, we're moving towards more human-centric opportunities driven by these technologies. So thank you, Mark, Carey, Paolo, very much. I think I pass this back to Jeff now.